Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined by Ben Brown from the University of Missouri. Good morning, Ben.
Good morning, Will. Happy March.
Happy March, indeed. Yeah. So we had some interesting things, happen at the end of February. A lot of fast movement in the markets, a lot of up and down to close out the month there as we set into new contracts, being the nearbys. So Ben, can you just give me an overview of what we saw last week?
Yeah, no, I sure can. I always love this time of year, but it certainly was stressful looking at the markets here the last couple of weeks. So that old crop May contract up 34 cents to $6.90. New crop corn only up 8 cents. So we saw an expanded negative carry there for corn. Old crop soybeans for May were up 26 cents to $16.36. However, new crop soybeans for November were down 29 cents. So again, that expanded carry there in soybeans. Looking at the soybean complex, soybean oil was up 4.5 cents per pound. Soybean meal was relatively flat on the week. Old crop wheat for May was up $1.11 to $9.34. And then new crop July wheat up 79 cents. Again, an expanded negative carry there as well.
What type of highlights did you see from the market last week?
So we had several things come out. USDA released their 10-year outlook for grain crops last week during the Ag Outlook Forum. Most of this information is usually known ahead of time, so there's little market impact. USDA acreage was within reason and matched most market analyst expectations. The trend line yields are just that. They're just a trend line for crops. They were a little bearish given how robust or how strong yields are in that trend calculation. U.S. ethanol production was up last week with ethanol stocks relatively flat. Export sales were relatively strong for corn, soybeans, and wheat. We continue to see fairly large new crop soybean purchases of basically insurance against the smaller global supplies is kind of how I would put that into a statement. Corn, soybeans, milo, and wheat export inspections were all down last week from the week before. However, China continues to take shipments from their really large committed unshipped supplies, and then managed money holdings of corn, soybeans, and wheat were all up and remain at elevated positions.
So going off some of the things that you said in your recap there, we're seeing some spread maybe between some nearbys and deferred contracts in the grain sector. So looking at a market carry, you're seeing inverted markets. What does that mean, and what does that signal to producers?
A great question. I guess a quick review of market carry. Market carry, or sometimes people refer to it as carrying charges, are the difference between two futures contract months. So they're the same commodity, but just different months. So you think of May and July corn contracts. Many people believe that difference is the market's expectation of price direction. And in some cases, that's accurate. So like a difference between May and December corn, if May is higher than December, some people would look at that and say the market is expecting corn prices to decrease from May into December. And that's somewhat correct. But then also you got to think about, like here in the United States, we're producing another crop. So we've got supplies that are coming onto the market, and that would push down price. So from that standpoint, it's partially true. However, this isn't completely accurate because new crop corn, again, like I said, is impacting that price. And so if we're just looking at the spread between the carrying charge is really a signal about when market participants like merchandisers, processors, and exporters need grain and are incentivizing or disincentivizing producers to store that crop. So we're experiencing an inverted market right now. You heard this during my market recap, and that continues to grow, or at least it grew last week. As of Monday afternoon, corn had a negative 20-cent market carry between May and July contracts and a negative 83-cent carry between May and December. Similarly, soybeans continue to have inverted markets, 20-cent negative carry between May and July, and negative $2 carry between May and November. Kansas City hard wheat and Chicago soft wheat are all negative as well. So a couple of market thoughts here related to marketing for old crop grain, meaning 2021 corn, soybean, and wheat production. The market is not providing producers an incentive to hold that grain. However, it does kind of create two different pieces of sentiment, right? So if the market is demanding grain right now, they likely will be demanding grain in July. And so It could be producers saying, hey, the market's going up. The market needs grain now. They're definitely going to need grain in July, and that's going to cause prices to go higher, right? So could prices go up by July? Yes. Could they also go down? Yes, because the market is basing that set of assumptions off of what we know today. And they're saying that right now they need grain, and they're willing to provide that incentive for producers to bring their grain to the elevator right now and help meet some of that market demand. And that's why we've seen basis soften across the country. Is there isn't that incentive for producers to hold on to grain. And so they're selling on these rallies, and that's pushing down local demand for the grain just a little bit.
Looking at global factors that could be driving those incentives that you talked about, I'm thinking of things like, obviously some tensions. I say some, a lot of tensions, and we'll talk about in a second. But the U.S. dollar first off, what adjustments are you seeing there, and what kind of power shift has that added or taken away from our exports?
Yeah, great question. So, with all the concerns on Wall Street and the events overseas, the U.S. dollar continues to strengthen. That's people around the world looking for a safe currency to trade with, and the U.S. dollar has that reputation. So the value of our dollar comparable to other export partners or what have you, could potentially have major impacts on our export shipments. And certainly I think we've seen that over the years, that when our dollar strengthens, we struggle with robust export programs, or at least at the same level with a weaker dollar, because it creates an environment where our products, without any change really, other than the currency, become more expensive. And that's what we're seeing right now, is our US dollar is strengthening, and that's making our ag exports more expensive.
And you talked about, the tensions, I guess we kind of both did there, but Russia and Ukraine. What's the update there? Because we've seen increased tensions and increased pushback from Ukraine and actual skirmishes in the last week. So has that already been priced in the market, or are we seeing adjustments because of that? What are you seeing from the market?
Yeah, I think a lot of that has been priced into the market. There's several indicators I could point to that. Probably the biggest one was last Friday with the big sell-off that we had in the grains. Well, really across the board, not just grains. That was largely people saying, "Hey, I don't want to be in this market over a closed weekend, or while the market's not trading, in case things drastically change for that region, the Black Sea region." And I wouldn't be surprised to see that same type of market reaction again at the end of this week if things haven't really changed. Just people don't want to get caught on the wrong side. But the invasion in Ukraine continues. The two sides met Monday near the Belarus-Ukraine border with no immediate agreements on terms of what to do. And tensions certainly continue to ramp up. Russia increased their nuclear deterrence forces. Western nations and Western allies continue to counter with increased sanctions on Russia as well. Probably the thing that we've been watching, and people ask me how sanctions play into the trade of grain. We haven't really sanctioned grain, and so grain could continue to flow out. But what we're seeing an almost cease of the trade out of that region, and that's coming for a variety of reasons. Grain prices within the Black Sea region have plummeted, and so meaning that if you've got a shipper willing to go into that region and get product and come out, there's profit to be made there, because again, cheaper prices there, and the rest of us are all experiencing surging prices through this. And so if you can find somebody to go in and get it and come out, there's profit to be made. The problem is, or some of the challenges are, that insurance premiums are high. And there's great concern over being captured. And so shippers aren't willing to go into the region and pick up product for countries, especially like India and Egypt, that depend on that Black Sea region wheat. They're not willing to do that, even though there's a market incentive to do so. On the flip side of that, one of the other concerns is exporters within the region are also hesitant to make contracts because they're concerned about getting product from inside the country to the ports. Just like here in the United States, we don't store a lot of grain at our ports. Basically, grain comes down the Mississippi River on barges, and it goes immediately from the barge to the ocean liner. We don't store grain at the ports. And so these port workers in the Black Sea region are concerned about their ability to get grain from central part of the country to the ports and onto boats. And all of that's basically ceased trade out of the region for the time being.
So right now, the region seems to be kind of fool's gold. It's there, but you can't get it.
That's right.
Looking at soybeans and corn, really the market drivers remain South America and South American weather. And we'll have some reports coming out later today, maybe also being market factors, looking at South American estimates. So we'll focus that a little bit more on next week and beyond. But Ben, I want to talk to you about crop insurance. We finally got the levels that those are going to be based on the February contract. So looking at corn, it's over $5.80, so a pretty high level there. What's that going to mean for producers?
Yeah, you're right. So this is the second highest base price for corn that we've had. For soybeans, it is the highest. So for that base price for soybeans estimated at $14.32 per bushel, that's up $2.46 from last year and nearly 85 cents higher than the all-time record set in 2011. So for both corn and soybeans, very strong projected prices set here during the month of February. That's going to be those base prices for crop insurance. With higher prices and increased volatility like what we've seen, that comes with higher insurance premiums. So for producers that haven't met with their crop insurance agent yet, please I guess this is my token of knowledge for you that crop insurance prices are going to be a lot higher this year than they were last year, and probably higher than you've seen in a long time, because the increase in yields are going to set some of our highest revenue guarantees that we've ever had across the board. And so prices are high. And with that, a lot of producers have been asking me if the harvest price option, so basically the ability to choose the higher price between the fall in October and this base price here in February, is worth the higher cost. And I do markets for a living, and I'm even puzzled in some cases in terms of what's going to happen, just because there's so much uncertainty in the world. So I polled a group of producers this weekend. It was a conference, top farmers conference, so farmers that are generally pretty in tune with the markets, and asked them what their probability was that the fall harvest price would be higher than our base price here in February. And only 22% said that they thought it would be higher by the time we got to the fall, meaning 78% producers thought that the price would be lower than these base prices. And so I turned it around and I said, well, that should, as a group, you all think that the harvest price option isn't worth it. And the cheaper harvest price exclusion could be a viable option, but let's talk about what you're giving up by doing that. But then we also turned around and said, well, why do you think price will be cheaper? And on the corn side, it is a mixture of things. South America is producing their larger second crop corn right now with an incentive to even produce more corn. And so that could put some downward pressure on corn prices. Good yield here in the United States was another option. But then on the reverse side, expanding drought in the southern plains, if that were to continue to creep up over the months of February and June, could put a lot of pressure on corn prices here in the United States to go higher. So it was kind of a neat activity to play with producers and think about expectations and sentiment as we head through the marketing year.
All right. Well, Ben, as always, I appreciate these discussions, and I always look forward to them every week. If listeners and viewers want to learn more or see more of things like this and more podcasts from Brownfield, visit brownfieldagnews.com. I'm Will Robinson, and this is Brownfield.